Good morning and welcome. You're tuned into Maket Cafe with me, Lisa Fernandez. I have my colleague with me, Ms. Snehi Shah. Good morning, Snehi.
Good morning, Lisa.
And this is the show where we'll take you through all the news that will be in focus both on the international as well as the domestic front. First, let's start on the international market. Snehi, there's a slew of negative news coming in on the US market. We have the Moody's downgrade on regional market, and even on European front also there is this windfall tax gains.
Yes.
So are the investor sentiments dampened because of this? Because the market
Absolutely,
closed?
Lisa.
Yes.
So good morning to you and wishing a very good morning to all our viewers. Let me take you through the US markets first then. And the biggest news this morning is the Moody's downgrade that has come in. And all three indices in the US markets closed lower after Moody's downgrade of several regional banks. The ratings agency Moody's downgraded the credit ratings of 10 US banks on Monday, and it warned that it was reviewing the status of some of the nation's biggest lenders. Now, this Moody's downgrade cited deposit risk, a potential recession, and struggling commercial real estate portfolios. Investors are coming off a down session for the major averages on Tuesday. The Dow Jones Industrial Average closed 158 points lower. Still, that's better than where the Dow was at the session lows, where it declined to as much as 465 points. Meanwhile, the S&P 500 fell by almost 0.5% and the Nasdaq Composite slid almost 0.8%. So not a very strong handover coming in from the US markets on the back of this Moody's downgrade. But let's also shift focus to Europe then. And European markets pulled back on Tuesday as investors braced for significant inflation data, which is due later this week, and reacted to a shock banking tax announcement out of Italy. Now, the Italian lenders took a hit from the government's surprise announcement of a 40% windfall tax on banking profits, dragging down the banking sector. The Pan-European Stock 600 index ended with a downtick of 0.2%, with banks shedding 2.7% to lead losses as most sectors slid into the red. However, on the positive side, healthcare stocks bucked the trend to add 3.2% gains on an intraday basis. So this is largely what the US and European markets look like. Both these markets taking sharp hits yesterday. So let's see what these markets will do in trade today. But with that, the ratings agency Moody's has slashed the credit ratings of multiple small and mid-sized US banks, and it has changed its outlook to negative for 11 major lenders on the back of recession fears and tightening monetary policy. We caught up with Nadia El-Bilasi, the market analyst of Equity Group, to understand how this will impact the banking sector in the US going forward. Listen in to what she had to say.
Definitely, we're seeing some weakness in the banking sector. This is not new news. We've already had a banking crisis just a few months ago. So it's only relatable to see that a few more banks will be downgraded, especially with higher interest rates. That's hurting the assets in banks, and that's also being reflected on the banking sector as a whole. Although we have seen tighter conditions, and even after the banking crisis, we've seen them put in place tighter credit conditions, we are still seeing downgrades made by Moody's. We've already seen a few weeks ago as well, Fitch downgrade the US bonds. So I think the situation right now would demand greater importance to what's going to happen soon. Maybe a mild recession is definitely in the books. I mean, it's not, it shouldn't be that far with things slowing down in the US, with the labor market slowing down. Yes, there's still higher wages, but there's still a lot of people unemployed. There's still a lot of factors that are affecting the economy.
Well, on one hand, we have the Moody downgrade coming in, but on the other hand, US EIA, that is the Energy Information Administration, they are quite bullish on the US economy because they have projected the GDP growth to rise by 1.9% in 2023, and that is up from 1.5% in the earlier forecast. And the report even suggested that the Brent crude oil prices will be averaging around $86 in the second half of 2023, and that is up around $7 from the previous forecast. The US crude production is also expected to rise by 850,000 barrels per day to record 12.76 million barrels per day in 2023. The report added, overtaking the last peak of 12.3 million barrels per day in 2019. So quite a rosy picture which has been projected by the US EIA. But on the other hand, the trade data that has come in from China, that is quite that might weigh on the crude prices going because it's quite bearish. China's July oil imports, that was down 18.8% from the previous month, and it's the lowest daily rate since January. But despite this gloomy data, analysts are quite positive about China's fuel demand outlook from August to early October. So that's on the crude. Let's look at how the crude oil prices are trending. The WTI crude oil, that's at around $82.7 per barrel, while the Brent crude oil, that's also flat and it's at around $86 per barrel. So that's on the crude and commodities check.
Thanks, Lisa, for taking us through that. With that, let's also look at all the cues that you should be tracking for today. And let's start with global cues then. We've got China Consumer Price Index and Producer Price Index. That's a CPI and PPI data coming out today. Important numbers to watch out for. On the domestic front, while we have no earnings from the Nifty 50 pack among the broader markets, we've got a slew of earnings today like Tata Power, Trent, Bharat Forge, BSC, Granules India, Bata, IRCTC, PI Industries, Veranda Learning Solutions, Berger Paints, Sula Vineyards, Dreamfork Services, Suntech Realty, and a list of, so this is a big list of all the important earnings that you should be keeping on your radar today. On the corporate action front, we have GMR Power. The board will be mulling a fundraising of up to 3,000 crore rupees. FTC will mull proposal for buyback of equity shares. We've also got Uno Minda, which will be mulling raising of funds via non-convertible debentures today. And Angel One will consider internal restructuring of businesses. We also have Berger Paints will consider a bonus issue today. Lots of meetings happening today, so important cues to be watching out on that front. And on the other events, then in other news, ISRO will perform its orbit reduction maneuver today. Just a few days ago, we got images from ISRO of the moon. It has entered moon's orbit, so it will be performing the orbit reduction maneuver today. And Pakistan's parliament will have the dissolution set happening today. So lots of major cues to track global as well as on the domestic front, Lisa.
Well, now let's move on to some global stories. Americans have increasingly turned to their credit cards to make their ends meet, which in turn has resulted in balances surpassing the $1 trillion for the first time ever. Credit card balances have risen by $45 billion to $1.03 trillion in the second quarter. The findings from the report reflecting well on the robust consumer spending, even as inflation continues to be a point of bother.
And staying with news flow from the US then, sources suggest that a US strategy is in the works to restrict investment in China and is likely to apply only to Chinese companies that get at least half of their revenue from sectors such as quantum computing and AI. The rule would allow private equity and venture capital firms to put their money in larger Chinese conglomerates with artificial intelligence divisions, but get majority of their revenue from other sources.
And on the macro front, Philadelphia Fed President Patrick Hacker, he has hinted towards the central bank's capability to finally pause the rate hikes. Barring any macro surprises, the US Federal Reserve may be at the stage where it can leave the rates where they are.
And shifting focus to Italy then, which is in focus on the back of a move that has surprised the street, causing bank shares to plummet. The country has passed a one-off 40% windfall tax on the profits banks earn from higher interest rates. A hike in interest rates has resulted in record profits for Italian banks, prompting the government's move. Proceeds will be used to help mortgage holders and to cut taxes.
And shifting focus, Reuters has suggested that Walt Disney has created a task force to study the artificial intelligence and its application across the entertainment space, even as Hollywood writers and actors battle to limit the industry's exploitation of the technology. Meanwhile, this has currently created 11 job openings in the company, seeking candidates with expertise in artificial intelligence as well as machine learning.
Shifting focus then, ESPN and Penn Entertainment have inked a $2 billion deal to jointly launch a sports betting business under the brand ESPN Bet. Shares of Penn gained 20% and Penn will rebrand its sportsbook service and relaunch it as ESPN Bet in the fall across the 16 legalized betting states where it has licenses.
And inflation is on the rise. A veg thali or plate in July is 34% more expensive than what it was in June. And this is according to the data which has been compiled by CRISIL. Of course, the tomatoes, that has been a large part to play in the spike. But the CRISIL report has taken into account the prices of cereals, pulses, broilers, vegetables, spices, edible oil, and also the cooking gas. Potatoes, onions, chilies, as well as cumin. Every ingredient that goes into making Indian food is seeing a sharp jump in prices. And who is to blame and what's the road ahead? Here's the report from my colleague Aishwarya Patel.
At a time when most vegetables as well as tomato are seeing prices skyrocketing, related products of tomatoes like ketchups, purees are still unchanged at this point. Take a look at HUL's Kisan, the 425 gram pack, which is 50 rupees. The non-garlic and non-onion one is 80 rupees, the double the price at this point. It's still unchanged. 1 kg bottle of Kisan is 155 rupees and a 1 kg bottle of Maggi is 160 rupees. And topping the list of them all is Heinz ketchup, which is 240 rupees for a 900 gram pack. Now, among all of these, if you see, the tomato content or the tomato paste content is anywhere between 23% to 28%. And the rest of the 70% is all artificial ingredients in most of the ketchup bottles, if you've ever seen the labels. So that is not just the reason why the prices are unchanged in these purees as well as ketchups. It is because the suppliers who provide tomato paste to most of these brands have a buffer of almost 18 to 24 months, which means they've bought their tomato purees or tomato paste almost at a time when the tomato prices were very low, and they're future proof to any price fluctuations in the tomato prices at this point. That's one of the reasons why we don't see any sort of price surge or inflation in these products.
All right, that's the inflation coming in tomato prices affecting ketchup prices largely. But with that, let's slip into a very short break. On the other side, we'll see how the Asian markets have opened this morning. Hi there, good morning and thanks for staying logged into Maket Cafe. Now, earlier in the show, we discussed about how China's CPI and PPI numbers were due today, and they have been released, and China has reported smaller than expected drop in consumer prices. Now, China has reported a 0.3% drop in consumer prices in July from a year ago and a 4.4% year-on-year drop in producer prices in July, according to the National Bureau of Statistics. China's consumer price index was expected to drop by 0.4%, and that has come in at 0.3% from a year ago, and according to analysts polled by Reuters, this is the figure. The producer price index was forecast to fall by 4.1% and it has fallen by 4.4%, so that has exceeded expectations, but it is the consumer price index that has failed to meet expectations of that drop coming in. This is all versus figures that was polled to come in a year ago, as well as the figures that have come now. On the back of that, you can see Shanghai has slipped into the red, down nominally just 4 points in the negative. Followed by that, you can also see Hang Seng has also slipped into the red, down 25 points with a downtick of almost 0.1%. Let's look at what the other Asian markets are doing in trade today, and you've got Kospi holding comfortably in the green today, up 1%, up 26 points in the trade. That's Kospi. Followed by that, we also have Nikkei has also slipped into the red, down almost 40 points, 0.1% downtick coming in for the Nikkei there. And lastly, we've also got Australia's ASX 200 up in the green, very nominally though, marginally up in the green, rather flat in trade at the moment. This is what the Asian markets are looking like. China taking a slight bit of a cut on the consumer price numbers. Absolutely, lots of interesting guests to look forward to on the market today, starting at 9:20. But with that, let's quickly slip into a short break.
Good morning and welcome back to the show. So we have at Tata Motors 78th AGM, the chairman N. Chandrasekhara. He said the company will continue to remain focused on executing its strategy to deliver the growth, profitability as well as the free cash flows. He also spoke about the company's debt strategy and also the EV plans. Sumit Chaturvedi, he's joining us with the details.
Well, Tata Motors, there has been made big strides in many sectors, including electric vehicle sector. So today, N. Chandrasekaran, Chairman Tata Motors, he said that the company will focus more on profitability growth and cash flows. He also said CV business is fast transitioning from being a pure play OEM, which is OE, original equipment manufacturer, to a holistic solution provider. So company, in a way, moving from just makers of Tata trucks to overall solution provider as well. It, however, said it's going to remain focused on executing its strategy to deliver growth, profitability, and free cash flows consistently. Well, Chandrasekaran was virtually holding this shareholders meeting in company's 78th AGM, and he also, in a way, emphasized on the importance of electric vehicles going to be in what are there in the portfolio of theirs. Tata Motors will launch 4 new electric vehicles in a few quarters. He also announced that he has said JLR, the international luxury brand, is contributing a lot, and it's also transitioning towards electric vehicles. So 50% of Tata Motors car business and 65% of JLR business will be EVs by 2030. All these points were elaborated by Chandrasekaran in the AGM today.
Absolutely. And on to an ET Now exclusive then, and specialty chemicals firm Dove Kettle is set to acquire Aquafarm Chemicals, a leading player in phosphonates, polymers and oilfield chemicals. This acquisition aims to secure almost 100% equity stake following talks with Aquafarm's founders and potential buyers like Bain Capital. My colleague Anurag Joshi is joining in with more details on this. Anurag, take it away.
The chemicals industry is bracing for more M&As. Specialty chemical firm Dove Kettle is poised to acquire peer Aquafarm Chemicals. Dove Kettle is poised to buy the founders of Aquafarm, led by its founder V.K. Mangwani. Mangwani had founded Aquafarm in 1974, and the company is Pune-based. And Dove Kettle, which was founded in 1992, is Mumbai-based. In the recent past, the founders of Aquafarm had been in talks with potential investors for a possible sale, and these prospective buyers include private equity firm Bain Capital. Now, Pune-based Aquafarm's products include phosphonates, polymers, and oilfield chemicals.
And now shifting focus on the earnings, Hindalco has posted strong set of numbers beating analyst expectations on all fronts in the first quarter. The profit for the quarter that came in at around 600 crore versus 832 crore in the previous quarter. Let's go across to Ashesha for the earnings fine print and also what's the brokerage is talking about.
Well, yes, numbers were well ahead of what the street was working with, although on a sequential basis it was a dip on account of lower commodity prices that we experienced in the quarter gone by. Both aluminium as well as copper prices declined by about 5% on a sequential basis, which impacted realizations this quarter. Revenues came in at about 19,000 crores, flat on a sequential basis. Margins, meanwhile, came in at 7.8% versus 8.9% that the company reported in the previous quarter. As far as the segment-wise performance is concerned, aluminium segment was impacted on account of lower LME prices, while copper segment was impacted on account of planned shutdown that the company undertook in the quarter gone by. CLSA, meanwhile, has come out with a note where they are maintaining their buy stance on the stock with a target price of 530. They say numbers were in line as far as the India business is concerned, that is the standalone business. They've guided for further cost reductions in the coming quarters. Leverage increase is seasonal. Remember, net debt has risen marginally, but they say that this is seasonal in nature and that the medium-term thesis is intact. So all in all, nothing shocking has come in. Largely in line set of numbers, sequential decline, but that is on account of lower commodity prices in the quarter gone by.
Ashesha, thanks for all those details and thanks for taking us through Hindalco's numbers. But stay with us then, because Coal India has also declared its numbers and the company saw its quarterly profits slip about 10% on a year-on-year basis to 7,972 crores, which is above analyst expectations. Margins too have narrowed. So Ashesha, break down these numbers for us then.
Well, yes, Coal India numbers were also better than what the street was working with. On a sequential basis, they were muted. Margin improvement is what we've seen on a sequential basis, but this is on account of one-off adjustment of wage provisioning that the company had done in the previous quarter. As far as revenues are concerned, they've largely remained flat on a quarter-on-quarter basis, and that is on account of lower volumes both in the e-auction segment as well as in the F&A segment. As far as revenues are concerned, they've come in at 35,900 crores. Margins meanwhile have come in at 29%, better than expected and better on a sequential basis on account of provisioning in the previous quarter. E-auction sales have declined by about 2% on a sequential basis, and e-auction volumes average realizations have also fallen by 17% on a quarter-on-quarter basis, which also impacted numbers this quarter. CLSA has come out with a note on Coal India where they are maintaining their buy stance on the stock, but they've gone ahead and cut their target price to 270 from their earlier target price of 277. CLSA says that first quarter numbers were largely in line with what the street was working with. E-auction realizations have been lower than their expectations, but dividend yield is expected to remain high. All in all, numbers slightly better than what the street was working with. No major complaints with Coal India.
Well, thank you, Ashesha, for breaking down the numbers for both Hindalco as well as Coal India. But now stay tuned for a big ET Now exclusive as AM Naik is gearing up to chair his last AGM at L&T. He talks about where the infra giant is headed, what's in store after he hangs up his boots, and also the role of L&T in building the nation. Here's a slice of that chat.
Now we have a platform, $6 billion of IT, and tremendous skill which no one has got. Show me a single IT company plus, so use that platform and build up what you have to do on digital and AI and automation and electronic component manufacturing in that area. On the other hand, in the same thing, other subdivision will do green power. Now, when it comes to green power of wind, it may still be done because of the nature in L&T1. Solar may be still done in L&T1.
So, have you formalized some kind of a structure within?
It is in my mind. I keep talking to our CEO. I'm sure that he has also similar thing in mind. And in our 5-year strategic plan, it is already reflecting. It has that kind of thinking. The problem is, I have been trying to get a CEO which doesn't upset the whole L&T. And that man wants 100 crore, 50 crore, 50 crore to nothing.
You've had some conversations
with whom?
With some candidates of this sort?
I had over time 2, 3, 4 candidates, but they always wanted huge stock option, like a startup company or very, very upcoming company where people give also the partnership and so on. Sure. The world have changed.
So how will it
and
fit
money
into...
has no value.
How will it fit into the current structure, which you have also groomed over the years in such an amazing manner?
Well, I think we will have to restructure not just as a division, 2 division, but little more where the rest of L&T don't see them.
As some kind of a competition type.
Yeah, and that's what we did for IT by forming a separate company. Otherwise, if they are part of L&T, which they were, it was not possible because 4 times more salary the industry was paying. If we pay, the whole L&T will go mad on us. Something will happen in this 5-year plan, which will be over in 2026 or another 3 years.
Hi there and welcome back to Maket Cafe. This is ET Now. Now let's also look at all the stocks that you should be keeping on your radar this Wednesday morning, and my colleague Ashesha is standing by to take you through just that. Ashesha.
Well, yes, first up, let's talk about insurance counters, where insurance data for the month of July is out, on account of which the entire sector will be in focus. SBI Life's APE growth stood at about 40%, while HDFC Life's APE growth for the month of July stood at a negative 5% on a year-on-year basis. Meanwhile, on the earnings side, Siemens reported weak set of numbers, weaker than what the street was working with, although on a year-on-year basis, it looks like a growth that is much lower than what the street was working with. Revenues have grown by about 14.5% on a year-on-year basis. Margins, meanwhile, stood at 11.6% versus 9.8% same time last year. Let's also talk about Engine One, where the board of directors will be considering restructuring of businesses today. The board meet is scheduled to happen today, so some restructuring announcement perhaps could come in. Lupin is also in focus on account of some US FDA action, where company's arm has received US FDA approval for a body oil products. On account of this approval that has come in, keep an eye out on Lupin as well. Moving on to Aarti Industries, then, weak set of numbers. On a year-on-year basis, revenues have declined by about 12%. Margins, meanwhile, have also contracted. They've come in at 14.1% versus 17.6% same time last year. So on a year-on-year basis, margins have contracted by about 350 basis points. Moving on to a metals counter, then, Shyam Metallics. Operational updates for the month of July are out, where sponge iron sales volumes have risen by about 33% on a year-on-year basis. Long steel volumes, meanwhile, were up by about 5% on a month-on-month basis. Lastly, let's also keep an eye out on Berger Paints, where the board of directors will be considering bonus issue today.
Thank you, Ashish Shah, for taking us through all the stocks that will be in focus today. But Vamakshi is also here, who will talk about what's on the brokerage's radar for today. Take it away, Vamakshi.
Well, yes, let me first start off with an India strategy note that has come in from Jefferies, and they have highlighted that the Goldilocks position for Indian equities particularly is getting questioned. There are a lot of negative triggers that are actually playing out, with the crude price rallying, China gaining some traction, rising India CPI, as well as yields moving up. Markets are expected to be likely range bound in the near term before the next leg up, is what Jefferies has highlighted. While the near term does appear weak, there are more signs of a capex upcycle. In fact, they have preference for domestic cyclicals such as financials, industrials, and property and mid-cap stays. As far as their model portfolio is concerned, they've moved 3 percentage points from Reliance Industries to banks. Other than that, we will also be keeping an eye out on PB Fintech. We have a note coming in from Macquarie, and they have highlighted that the Bima Sugam platform could be disruptive. It could affect take rates as well as market share, and in fact, they are questioning the target market potential that the company has stated, and the valuations for this counter are also appearing to be quite high, at nearly 48 times the FY27 price to earnings. So on the back of that, Macquarie has maintained its underperform rating on PB Fintech, given a target price of 560 rupees per share. And lastly, keep an eye out on Siemens. Macquarie has highlighted that the company did receive some stable orders, but the execution was offset by weaker margins. Order flow was sustained above the 5,000 crore run rate for the third consecutive quarter. In fact, the strong gross margin performance indicated that there was no pricing pressure for Siemens. So on the back of that, we have Macquarie maintaining its outperform call on Siemens with a target price of 4,100 rupees per share.
Absolutely. Thanks, Vamakshi, for taking us through that. We will be tracking these stocks in trade today. But stay with us then, because Kotak Institutional Equities has come out with a note on insurance companies with a focus on SBI Life. So break down this report for us, Vamakshi. Tell us what it says.
Well, yes, when we look at the individual APE growth, that was quite strong at almost 18% in the month of July. Growth in the number of policies was also quite strong, up nearly 14%, and this is higher as compared to 0 to 10% growth that we did see in the previous 3 months. The data also indicates that there has been a shift in product mix towards the lower ticket policies and terms, and in fact the repricing of non-par policies has also likely prompted higher group business last month. Now let me take you through some of the companies that have reported these numbers. Now SBI Life has shined. In fact, they're seeing a very strong bounce back, strong growth of 40% that they've reported in the month of July, and this was partly boosted by their group business. APE growth was also strong at almost 31% on a year-on-year basis, and this is much higher than the growth rate that they had posted from the April to June months. SBI has ramped up the business in order to offset the weak numbers that the company posted in the first quarter. Max Life also performed well. They reported a sequential improvement in growth at nearly 21% for the month of July. In fact, after the blockbuster growth that they posted of nearly 60% in in March. Volumes were weak in April as well as May, but they have now picked up for Max Life. HDFC Life, on the other hand, it did shine for the last 2 months, but they have reported a decline this time around. They've reported a 5% decline in the APE that was driven by mainly a 7% decline in their individual businesses. Transition to lower ticket sizes and higher share of protection has likely led to this moderation in APE. So all in all, the key takeaway from this report is that SBI Life has outperformed while HDFC Life is seeing a decline.
Okay, thank you, Mamakshi, for sharing Kotak's view on the insurance companies. But now shifting focus on Morgan Stanley's view on the emerging market. India versus China is the key theme to watch out for. And for that, we caught up with Jonathan Garner, who is the Chief Asia Emerging Markets Equity Strategist of Morgan Stanley, on his view. Let's listen in.
I think valuations have cheapened up for India since last October in relative terms quite considerably, as other markets in North Asia like Taiwan and Korea have outperformed the Indian market quite substantially. So there's better relative valuations than there were. But if we zoom out, really the medium-term story is what excites us so much about India. We're starting to see a trend of superior US dollar earnings per share growth over the cycle versus other emerging markets, and particularly versus China. And we're also seeing the currency, the Indian rupee, sustaining a real exchange rate trend that is stable to positive at a time that the Chinese renminbi, for example, has become really quite weak. So what we're seeing is portfolio investment is actually moving towards India at the moment. And that means that though the multiple in absolute terms, to answer your original question, about 20 times 1 year forward PE, may look high compared to emerging markets on about 12 times, this superior compound earnings per share growth and portfolio equity inflows likely keeps the market very well supported.
If one looks at the global scenario, 2022, we saw mass outflows out of India to China. When we started the year, that pattern was at play. But since April, foreign institutional investors have come back into India, both by the portfolio route and by the FDI route. Do you think this could be a multi-year trend in making, and now we should get accustomed to strong flows by institutional investors, especially foreign institutional investors, into Indian equities?
Yes, we do. What we now know is that the economic recovery in China has been very lackluster. And certainly there is a debate amongst investors as to whether it's reached an important multi-decade transition. Its demography is quite adverse, and that's in contrast with India in terms of the population age distribution. And that matters not just for themes like consumer, industrials, financial stocks, earnings, but it matters for the demographic that can now buy equities in India. So again, for China, the near-term issue around leverage and the property sector's issues is causing a real challenge for policymakers, and it is weakening the currency. Whereas on my recent trip to India in June, I was very struck just how strong the economy is across the board in manufacturing and services PMIs, and real estate transaction volumes and activity, in inward FDI and infrastructure construction. It's a very interesting story to us in India.
Jonathan, your report explicitly talks about where China was in the past, India will be in the future. Now, that's a very powerful comment, and I love when somebody says such good things about India, being an Indian. But can you elaborate more on that?
Well, if we simply look at metrics like GDP per capita, for India, we're standing at around 2,500 US dollars. China's about 13,000 US dollars. China's growth model is running into trouble. India's has a long way to run. If you look at leverage, household leverage overall in the economy in terms of debt ratios to GDP, they're still extremely low, a feature that is shared with Indonesia, for example, but it's in stark contrast to the situation in China or North Asia more generally. And again, we know that in this multipolar world dynamic that is ongoing, India has significant optionality there in terms of the way that firms from the United States, Japan, Taiwan, elsewhere are relocating at scale their production platforms into India. So there is an awful lot of room to run here in India's growth model. We're very excited about it.
Do you think that in this transition, as money migrates from India to China, we could be looking at serious changes in terms of capital allocation. We could be seeing serious changes in terms of MSCI allocation, because if I look at the MSCI emerging market allocation, China still has the largest weightage and largest component.
Yes, I think you may have misspoke there in your question. We're actually seeing that fund money is moving from China towards India, not away from India towards China. And we think that move towards India has considerably further to go. What we're starting to see is the development of the emerging markets ex-China product. India is a very large weighting within that index. And so when we look at portfolio flows generally, we are seeing that structural change that's underway. It's also ongoing into markets in ASEAN, like Indonesia and Singapore as well. But India is set to benefit significantly.
All right, that's the word coming in from Jonathan Garner, but let's get a move on then. And Sridhar Sivaram, the investment director at Enam Holdings, believes the PSU space in India is an interesting space and currently undervalued. Listen in to his rationale behind this view.
So I think contra bet, we've been long the PSUs generally, PSU banks, PSUs, and that trade has played very well. We are still very bullish on the PSU banks given the earnings. I mean, that's a segment where people, earlier there was a consensus negative. Yeah. Now I would say it's a 50-50 where some people...
But even the lower order banks and not just the large bank SBI?
Yeah. So we're quite bullish on, there are just 4-5 banks investable in the PSU basket.
So should I start taking names and you will say no for them and yes for the ones?
Out of them, barring 1 or 2, the rest are investable actually, and they look reasonably good. Look at their earnings. I mean, they're still trading at 4-5 PE.
But why were NIMs were down? I looked at SBI and BOB, NIMs were down. Managements are saying that you hit a peak in terms of the credit growth. So if the business is not going to be in the expansionary mode, does it make sense just to look at value and then buy them?
So I think over concentration on NIM also is an issue. So what you have to look at is what is the operating profit growth. So you look at the operating profit growth is still growing at say 10 to 15%. Yeah. Your credit cost is broadly stable or down. See, keep in mind that credit
ROAs are also going higher.
So you keep in mind that private sector credit costs have already come down substantially. They are at on an annualized basis 50-60 basis points. Most of the PSU banks are, barring SBI, most of the PSU banks are in the 1 to 1.5% range in the credit cost. That can still come down to say below 1%. So what you're seeing is your operating profit growth is say 15%. Your PAT growth is almost 50-60% even now. And that's coming predominantly because of this reduction that we are seeing in the credit cost. And we think that will continue to play. Some of these banks are trading at say 5% dividend yield now because they have to pay 20-25% of the profits as dividend. So, I mean, whichever way I see, it looks an interesting space. We think that a lot of the re-rating has already happened. From here on, even if you get earnings growth returns, that itself could be 20-25%. So, I mean, that's how I'm seeing it. Only time will tell whether we are right or wrong.
All right, that's the word coming in from Sridhar Sivaram of Enam Holdings. But with that, we're completely out of time on this edition of Market Cafe. Don't go anywhere. The market will take all the action ahead.